this is where we will now look at the criteria in terms of our definition of our asset and liabilities separately, and then incorporate this with our recognition criteria. But before we are able to do this, what is important to remember in a discussion question is that you will first have to discuss the definition in terms of assets, liabilities, income, expense. Once you're able to conclude that yes, this is asset or liability, we need to discuss our recognition criteria. And only once the recognition criteria are met, you may recognize that asset or liability. Right. Now, let's first focus on our asset. Now, remember the asset, if you think about the definition, it's a present economic resource controlled by the entity as a result of a past event. Our economic resource is the right that it has to potentially produce economic benefits. Okay, so when we look at our asset, our first criteria that we need to meet is there has to be a right. Now, what is a right? This can be a right for the entity to receive cash or to receive goods or services, or there can be an agreement with another entity to transfer economic resources between the entities. Remember guys, a right can be in quite a lot of forms. You need to identify in a scenario if there is a right. Then important, that right can only be an asset if both of the following are met. Both, therefore, number one, it has to have the potential to produce economic benefits, plus two, the entity has to have control over the right. Okay, guys, this is our definition. It has to have potential to produce and the entity has to have control. Therefore, what you need to identify from this is that there can be scenarios where there's a right, but that does not automatically mean that that will be an asset. You need to focus on the fact that there has to be the potential to produce income from that asset, or from that right, guys. Sorry, not from the asset, from the right. Okay, now look at your liability. Remember the definition of our liability: present obligation of the entity to transfer economic resources as a result of a past event. First criteria, there has to be an obligation. Now, what is an obligation? No practical ability to avoid, to make payment, to transfer, and this is your keyword, no practical ability to avoid. Therefore, in a scenario, this is what you will have to discuss. And then, in terms of IAS 37, I'm pretty sure you can remember, obligations can either be legal obligations or this can be constructive obligations. I'm not going to go into detail with this, guys. I'm pretty sure you remember this. Now, let's take this one step further. When we look at our asset, our second criteria, the right has to have the potential to produce economic benefits. Now, guys, you will remember in our previous, our old conceptual framework, we would talk about the probability. Okay, now important on this one, the new one, this potential does not have to be certain. Weird, hey? Does not have to be certain. Therefore, it does not even have to be likely, not even likely that this will happen. And we talk about this, or we refer to this as the probability is low. The probability of producing economic benefits is low. Therefore, this right, and this is interesting, this right can be or can meet the definition of our economic resource. Remember, economic resource, the right that it has the potential to produce future economic benefits. Okay? Even if there is a low probability that this can happen. You still with me, guys? Okay. Now, if there is a low probability, remember probability, more likely than not, low probability. This will affect the decisions about what information to provide. Therefore, this will have an effect on the decisions in terms of the information. Remember, what is the objective? Useful financial reporting. Useful for our readers, the users, to be able to use the information. Okay, guys, therefore it is important that we will have to include in discussions whether the asset will be recognized or liability, guys. I'm going to show you just now, recognized. And then also very important, how will they measure this? Now, look at your liability. Number 2, obligation to transfer economic resources. Look at the difference. The asset, we will refer to economic benefits. The liability, we refer to our economic resources. Now, guys, exactly the same as per the asset section. This obligation does not have to be certain, not even likely. The probability can be lower. Right? Therefore, we now know, not right as per the asset, we now know that there can be an obligation if there is a low probability of transferring the economic resources. Now, look at the asset section for me again. We need to discuss control. Control will exist if and only if 1. The entity has the present ability to direct the use. Now, very similar to IFRS 10. Hey guys, our entity has the present ability to direct the use of that right or our economic resource to generate future economic benefits. With me. Therefore, and to be able to obtain the benefits, the economic benefits from the use of the right. And that economic benefits, remember, this can be indirect or direct benefits. Okay guys, so normally which will help you in a scenario, your economic resource and your entity, when you are able to identify and assess if there is control, it will help you to link the economic resource to the entity. Therefore, if you struggle to do this, look at control first, and then you will be able to link your economic resource to your entity in a scenario. Okay, next, refer to your liability. There has to be an obligation as a result of a past event. Now, the conceptual framework indicates to us this can only happen if the following 2 criteria are met. If 1, the entity has already obtained economic benefits or taken action on it, plus 2, as a consequence, the entity may or will have to transfer economic resources it would not otherwise have had to. Okay, so think about this one, guys. Number 1, entity has already obtained economic benefits or taken action on it. If this has happened in the past, the entity has received some kind of economic benefit from that, or taken action on that, guys, on economic benefits. Plus, as a consequence, the entity will have to transfer economic resources due to what happened, due to the word already, focus, already, and due to the already happened, there is a consequence of transferring economic resources. Okay, right, now this is the definition of our asset and our liability. Now we need to move on to our recognition criteria. Remember, this will be in terms of our relevance and faithful presentation. Now, there can be scenarios where the existence of your asset or your liability is uncertain. If there's a scenario where the existence of the asset or liability is uncertain, this will normally be or normally go hand in hand with a low probability scenario as well. What does this actually mean? That there is quite a lot of difference in terms of the outcomes, guys. Yes, no, maybe, we don't know, it's low, it's very low, it's medium. We don't actually know what this outcome will be. Okay, therefore it is unlikely we will not be able to provide a single amount. Right, therefore it will not provide relevant information if we recognize this asset or liability, or if we even not recognize the asset or the liability. Guys, and I think this might be a difficult section in a scenario. You cannot recognize a single amount due to the fact that there is uncertainty if this is actually an asset or liability. But we will have to provide additional information in terms of this. Therefore, think about your your contingent assets liabilities. I is 37, guys. Possibility of a link. Right, let's move on. Now, when we look at the asset, the liability, the middle category. In terms of our asset, the potential to produce. In terms of our liability, the obligation to transfer. And we have identified that the probability can be low. Now, what happens if the probability is low? We will have to ensure that in the financials that they provide the most relevant information in that scenario. Therefore, in terms of a discussion question, you will have to identify in the given scenario, what is your most relevant information? Now, guys, this can be the magnitude of our possible outcomes, to the possible timing that you will have to discuss in a scenario, and 3, any other factors that will affect the probability of occurrence. Now, let's say, for example, in a scenario, this should be disclosed, or you need to identify this from a given scenario to discuss. Okay, now let's say, for example, in a scenario, they indicate to you that they have purchased or exchanged this asset liability on a market. Now, guys, remember, in terms of IFRS 13, the market can represent quite a lot of scenarios, but the main thing, it has to be observable. If it is observable, you agree with me that it will be easier to support that amount and the possibility, the probability that there is an in or outflow of cash. Therefore, if you do not recognize this asset or liability, this is not faithful presentation. And most probably in such a scenario where you are able to support your amount with a cost. And then to take this a little bit further in terms of possible in and outflows of cash, rather recognize that as an asset or liability compared to an amount that is not observable, not on a market, not observable. Do you think that that will actually have a value for the users if you include that, guys? No, it's not really relevant for the users. If you're not able to support the amount, it's not relevant, and do not include this. Okay, therefore, do you see now why I have included the different scenarios or the different criteria in a table? Now, in terms of measurement, guys, if we think about measurement, let's be really, really honest. There's always some instances, if we do not have the actual amount, where there is an uncertainty in terms of an amount. But what is important, you need to focus on what is most relevant. Now, this is your keyword. What is most relevant in a scenario? And with any estimates, it always has to be clearly and accurately documented. Right, now guys, this is the crux. Now, what I want you to do is you need to work through the conceptual framework. There's quite a lot of basic, smaller examples. From a timing point of view, I do not have time to work through all of this with you. Please spend a little bit of time on that. Please ensure that you are comfortable with the discussion of your different elements. We have now determined that we meet the definition of an asset or liability, income expense, recognition criteria, and now we need to select the methodology for measuring the elements, and this we call the measurement basis. Now, in terms of the useful financial information, the consideration of our qualitative characteristics and the cost constraints is likely to result in the selection of different measurement bases. Now, the conceptual framework refers to our historical cost and our current value. In terms of the historical cost, this will be the transaction costs on transaction date. When we look at our current value, this is divided into three. The first will be fair value, then our value in use in terms of our assets, and they refer to the fulfillment value in terms of our liabilities. And number three, our current costs. I'm not going to go into detail with this, guys. You can do this on your own, please. Not a lot of information. Then there is a few other factors that you need to consider, such as our fundamental qualitative characteristics, such as our relevance in terms of the measurement basis that you choose, in terms of our faithful presentation, and there might be factors specific in terms of the initial recognition. And when you refer to the conceptual framework, I've included here for you page A57. There's a table 6.1, which is a pretty good summary in terms of the measurement basis. Right, guys, presentation and disclosure. Remember that this is our communication tool. I'm not going to go into details in terms of this. You know the objective and disclosures, classification, assets, liabilities, group everything together. And guys, aggregation. Do not provide too many detail, but ensure that the detail that we provide is faithful and relevant. Right. Then the last chapter of our conceptual framework, concepts of capital and capital maintenance. The conceptual framework referred to 1, the financial capital maintenance, which is the net assets in your financial statements, and 2, it refers to our physical capital maintenance, and this is where we look at units, physical productive capacity or operating capability. This is normally units. It is certain different criteria in terms of the different entities. Right guys, now this is our conceptual framework. I think when you look at this, important to be able to discuss briefly the qualitative characteristics as well as the elements in a scenario.